Good morning, friends. Welcome to this very important edition and the first edition of the new financial year of the Multimillionaire Forum. As many of you know, we do this on the first Saturday of every month. We have this little webinar. We pick up a subject of common interest, something that's happening around us. Some subjects are routine. And there is a little change that we have done in this year. This year, instead of talking about opportunities for the new year in January, we shifted this session to April. And there's a lot of reasoning for doing that. And we thought, let's go back to our basics. From a Vedic point of view, from our Shastra's point of view, this is the time of Chaitra Shukla Paksha, and this is the time where this is the time where the new year actually begins. And this is why so many of our Indian festivals happen at this time, whether it's a Gudi Padwa or whether it's a Ugadi or whether it's Baisakhi. So there is something logical, spiritual, Vedic, astrological, and there are multiple reasons why this new year begins here. Maybe our finance ministry also thought about it, and that's why April is our financial year starting. So that's the reason we sort of thought about doing this thing in April. A lot of things happen in April, a lot of things change in March and April, and which is why you will see in a little while as we go through the presentation why April was like a very good choice to have this opportunity session. Plus, it is incidental that right now, whatever is happening is a lot of turbulence around us. It's been almost about now 2 years since this turbulence has started. I mean, we just had about a good time till about June of 2024. And you will remember in June 24, when BJP did not get 400 par, and the volatility and the downswing that started from there. So we saw downs and ups and downs and ups in the market again. So what this implies, how bad is it, how good is something that we are going to have a little analysis and we're going to look into it, right? So if you can bring up the presentation, please. Thank you. This is a standard disclaimer. What we do is we only do this from a purely educational purpose. So we do not have any product recommendations of any sort happening here. And as you can see, we are broker distributors of financial products registered by SEBI and AMFI. So what we will do is we will speak for about 30 to 40 minutes, and we will go on with this little presentation that we've compiled for your information. Once we stop the presentation, then we can have a question answer session, and in that we can have an open forum and we can discuss anything and everything that you want. So, history basically tells us that this is not the first time a war is happening. This is not the first time we have seen this kind of fear factor happening. And every other day we feel that some bad news comes up and the market falls about 2-3%. Good news comes up, it goes by about 2-3% up. This is not the first time. We saw the last incidents of this happened in 22 with the Russia-Ukraine war. And some of you might remember that in 23 we did a very elaborate session on war and stock markets and the relationship, and we found that there wasn't much. And we went to as much as 1,000 years in the history, and we did analysis from the year 1000 to current time frame, and we saw what happened as a result of war and what happened as a result of war to the financial markets. So we saw that there was not a huge connection, and which is why this word here, volatility, becomes extremely important. If we look at this entire activity as a volatility event and an event of opportunity, then a lot of things, generally start shifting in our mind. Okay, but typically what happens is when these kind of scenarios happen, markets fall, as you all know, great opportunities get created, and obviously wealth builds. Now, this is very common and everybody knows it, but understand how bad is the situation. Let's get into that first, okay? And there are 2-3 pieces of evidence to see how bad is it. Is it really bad? That's what we want to try and investigate. So the first thing that we have for you is a very interesting statistical analysis, and it's known as the bell curve analysis. Now, what you see in this bell curve, and I will use my pointer to explain a little bit. What we have done here is an analysis of the last 429 months, which is nothing but 36 years of data. 36 years essentially starting from July of 1990 to the current month. And what we are trying to here say is that in a single month, what was the number of times that the market fell more than, say, for example, 10%. Okay. So, and I will repeat and I'll repeat slowly so that you all catch it. We took the data of the last 36 years of the Indian market, and in a particular month, we tried to find out on how many occasions, on how many months did we actually see a 10% drop in the market. Okay, 10% or more drop. Now we see out of 429 months, there were only 23 months. So right now, I mean, ignore the colorful picture, but just focus on this little table that you have. We found that 23 months, we had a situation where the market fell more than 10%. Okay, 23 months out of 429 months, the market fell more than 10% in a single month. Now, that's exact thing has happened right now in March of 2026, when the market has actually fallen about 12%, right? So that is observation number one. And like that, how many observations happened in the past where the markets in a month fell more than 10%? Sorry, I've repeated two, three times just to make sure that you understand this concept very well and everyone catches it. When you sort of divide 23 by the total months of 429, we see that this activity, what we just saw in March of 26, has happened only 5% of the times. Okay, very pertinent to note. 5% of the time this has happened. On the opposite side, how many months have we witnessed that the market went above 10% in a single month? And there we see that the observations were 41, which is about 10% of the time the market has given a performance of more than 10% appreciation in a single month. So both the extremes have been taken, and this is what this beautiful bell curve tries to say, that extreme situations actually fall in this zone, extreme negative situations fall here, which is nothing but this 5% observations where market actually fell more than 10%, and extreme optimism has also happened only 10% of the times where when the market moved up more than 10%. So on the lower side, it is only 5% times bad times have lasted. On the upper side, it's only 10% of the observations. Now, if you see the large majority, about 31% of the time, the market was somewhere between 0 to 5%. And about 30% of the time, the market was in a plus 0 to 5%. Most of the times we exist here. And that is how appreciation happens in the market. And this is what we'll call as a rally period. And this is what we call as a trough period. Because there's only about 10% of the times when the market is in a bear situation. And there is a 15% time where the market is in a super rally situation. So this just tells you that if this period has been extremely frustrating and very, very restrictive, strangulating, so to say, it only occurs 5% of the times, which is essentially 23 times in the last 429 months this has happened. So we can, ease nerves. It's not so bad. Perhaps the worst has got over. And I would even hazard to say maybe a turnaround is going to happen very, very soon. So, but what happens as a result of, this situation? Sometimes, they say that 2 months of not having cash can actually crash a whole organization. You might have 100 crores and thousands of crores of assets, but if you did not have cash flow for 2 months and you didn't get meals to eat, survival becomes a question. And that is exactly what happens in these kind of desperate situations. What happens is, a lot of times from our investor point of view, a lot of times we tend to sell off at this worst time. So a lot of investors in desperation tend to exit here, which is an event that only happens 5% of the time. So if at all you were thinking of something like that, I would say please refrain from doing that. Do not think in that direction. That happens only 5% of the times. And this time, that 5% part has already gone behind us. So now it cannot be more worse than this. But I mean, hone ko kuch bhi ho sakta hai. But having said that, we are statistically speaking in a very, very good situation going forward. Why and how, I don't know. Nobody knows. Nobody knows when the ceasefire ends on the 6th of April and what's going to happen after that. They say it's going to be another 2, 3 weeks. but we really don't know because things are developing on a day-to-day basis. But let's sort of look at, there's a lot of other data to see. So let's move forward. Let's look at the, so once we have seen statistical analysis, let's look at business. Okay. Now, one very important thing that happens, all the time is, if the business is bad in the country, the market will fall down. If profits don't happen, the markets fall. So question is, because of the war, because of this situation, has the profitability gone down in the Indian market? Let's identify and investigate that. Can you bring the profitability slide? Okay. Now, what we are showing you here is the past 6 quarters of data, something that we continuously monitor. You may want to reduce this a little bit, just a little bit. Or you may want to just hide the September and December figures of profit and September of December of sales. So we see last 4 quarters. I mean, September, not that one. That is December. That is 25. H and I column. Can you just please hide them? Yeah, and likewise, can you go back on the left and hide the sales columns also? Left. Yeah, can you hide the B and C columns also? Okay, so now what you see in front of your screen, and stay with me, look, I would like you to focus here on this little chart, on this little graph that you are seeing, okay, in front of you. This is the sales graph of the last 6 quarters and the net profit of the 6 quarters. Okay, these two columns. Look at charts that are like this, or look at indicators. Look at this. This is a beautiful line here. This is also a reasonably good line here. This also has a little bit of a dip, but then it's kind of moving up. What this is trying to show you is that, I mean, the red flag would be, what this is trying to show you is that things are good. If the line was down like this, or if it was some sort of a curvy line coming down this way, then this is a red flag. This actually means that, there is no profitability, or profitability is going down, or there are losses happening. Now, what you see in front of you, the first column, are the various industries. So, for example, we have taken, let us, for example, consider the metal sector. The metal sector, all the companies of the metal sector have shown that their sales have pretty much remained steady. They have not really gone down. We are not making losses. But the profitability has gone up quite interestingly, from 22,000 crores to 31,000 crores. This is metal sector, and this is represented by this little line here. See, the way we are presenting data is, this is a sector, and all the companies in the metal sector all the sales of all the companies have been added, all the profit of all the companies have been added. So this is a representation that you're seeing here. In the same fashion, if we, for example, look at chemicals, chemicals is interesting. From 1 lakh crores, this is quarterly figure, mind you, these are not annual figures. So quarterly, in the last 4 quarters, if 1 lakh crores has become 1,16,000 crores, it means it's an appreciation of 16% in terms of sales. And profitability has gone up from 7,000 crores to 12,000 crores. This is almost like 60% profit, which has gone up for the chemical sector, and which is represented by this little line. You can remove your selection on N and O. Click somewhere. Yeah, that's better. So this is represented. This is the profit line for chemicals, and this is the sales line for chemical. So this is something that we must be very happy about, because see, if there is profitability happening in the overall situation, in the overall Indian market, then there's lesser reason to worry. Yeah, it is falling because of a lot of reasons, perhaps FIIs, perhaps something else that you may have heard. We'll come to each one of those also. But in essence, profit is on an upward moving slope. These are internet, tourism, chemical. Can you scroll down, please? Let's go to further industries. Let's look at financial services. Look at, this is 6 lakh crores to 6 lakh 62,000 crores. 10% growth here. Profit has not really gone up so much, from 64,000 to 66,000, but it's not gone down, mind you. So very important. The business is steady, and business has not suffered despite tariffs. Remember what happened in June or January of 25? Mr. Trump came to office, and the first thing he did was he hammered us with his tariff. And of course, the impact was on the American consumer. But the thing is, in the meanwhile, the whole world trade got shaken up. Let's further go down. Let's look at this. Let's further go down. Okay. So yeah, pretty much all sectors. Realty sector from 25,000 crores to 26,000 crores, 4,000 to 6,000 profitability. Manufacturing, very important. Manufacturing has remained steady. It's not gone up, but it's remained steady. Profitability has just gone down a little bit. Okay, so that's the only first little down that we saw, 10,600 to 9,600. Otherwise, we've not seen. Consumption is okay. Financial services okay. Uh, which sector is this? This particular one I can't see. Okay, can you scroll down a little bit? Okay. Pharma sector. Pharma is also okay. 16,000 maintained at 16,000. So you see, in a bad time also, this was IT. I couldn't see it first. So IT has moved from 2,27,000 crores to 2,50,000 crores. But the IT profitability has gone down. See, now you hear things about Oracle sacking, thousands of employees, and other companies are sacking employees. But from a sales point of view, business point of view, it's okay. Profit point of view, it's all right, which means the stock price should be all right. In the interim, it can fall because there's a lot of external pressure for the stock price, a lot of players who are actually selling the market. But other than that, we are absolutely okay. There is nothing to worry from a profitability and from a sales data point of view. Okay, let's look at the third angle. What's the negative? There is a third angle also. So we spoke about how bad is the war and the impact. So now let's just look at some of the last wars that we've seen. Can you bring up that data on war and what happens after a war? Let's look at that. You can bring up the Excel. All right. So what you are seeing here is we have taken some very important wars and one very important event, which is the 9/11 attack that happened almost 25 years ago. Okay, but going back, this is the current situation: the U.S., Israel, and the Iran war. But the previous one, January 22, the Russia-Ukraine war, and the Nifty was at 18,200. And in about 3 years' time, in 1 year, it remained the same. But in 3 years' time, Nifty did a 26%, and as you know, that was like one of the best times. Small cap and mid cap did more than 70 and 80% returns post this war. There is a history of the US-Iran tensions of 2020. 12,000 was the Nifty, and in about a year's time, it went up 16% and 49% in 3 years. And 5 years, we obviously know. But incidentally, mind you, 3rd of January 2020 was before the world saw the announcement of COVID. So, I mean, we didn't know COVID was going to come and strike in March. But at that point of time, the market actually had also gone down. And then this is the result. Iraq War of 23, obviously, in a year's time, you saw some fantastic returns of 67% in 3 years to 20%. And if you're interested in further details, which month was it? November of 23, where we did this whole session on war and stock market. Okay. Even in that session, in a very elaborate fashion, we explained wars of 1,000 years. And we spoke that every time we found out that a war happens, within a year or two, to 2 years' time, everything gets sorted out. In fact, in a year's time, it gets sorted out.
November of 23.
Okay, thank you. November 23. So, and that video is already there on our YouTube channel, so you may also have a look at that. All right, let's come back to our presentation. So, what's the next thing that we want to show you is some very interesting data on what we are seeing in terms of actual price action, the things that we live with on a day-to-day basis, right? So, yeah, profits, we saw this. Can we move forward? Okay, we saw this also. So we spoke about what. Okay, let's do a sector review. Yeah. So now I'm going to show you some charts. Again, this is a very simple way, visually and pictorically, where you can see that the correction is almost sort of done. Okay, can you bring that up, please? You will see that each of these sectors, there is always a buy and a sell sort of data that we have and which we map on a regular basis. But this is the first time we want to share all this data with you on a sector to sector basis. We would have shared this in between, but my team is just working on putting this thing up. Take the presentation off. Okay, fine, no problem. Take your time. In the meanwhile, you will see that, everywhere the speed at which we have corrected has kind of reached a point of culmination. Now, the thing is, one may be an extreme pessimist and say, well, things can go even worse. Things can become even further bad. There are those kind of things that also can happen. But then that's extreme pessimism. That way, what may happen is, let's say India, Pakistan also get into a war, China and Taiwan get into a war, or China and Russia start jumping into this Iran war. So, for that sense, I mean, there are extreme events that can happen, and yes, I mean that can also affect the markets quite terribly. But in the meanwhile, the way the situation is, as is various basis, nothing really is going to be so bad going forward. So I just want to show you that. What's the problem? Are we getting it? Okay. Okay, my team is still working on getting it. So in the meanwhile, so far, is it okay? I mean, so far, is there a little bit of clarity in terms of what's going on from a war historical scenario, from a fundamental data point of view? There is absolute clarity. There's nothing, and from a statistical analysis, there is not such a big problem. Okay, this is where we are. So can you first show us the total market? Can you show us Nifty 500? I'm not going to do any fancy analysis of any sort. All I'm going to try and show you, just stop there, is look at this. This is the current fall, okay? This is like a line that we draw here. The current fall seems to have done its job. It cannot possibly fall like that and go down to zero, right? That's not practically feasible. The country is not shutting down. So what happens is every time, the markets fall, normally, like if you see this fall also, it does not fall below the previous fall. Every time it does this thing, this was the previous fall. Even in the COVID factor, when it fell, it did not fall below this threshold. So these are different thresholds that are made. So we are very, very close to our threshold. So, like I said, for have to happen, if things go really bad, yes, the worst can happen. But the last 35 years, such a thing has not happened. Let's also show you for a moment. Let's show you. Can you just put up S&P 500? Can you show the American market? So it's not happening in the American market also. Okay, let me just clear this thing. See, American market. Look at the thresholds, right? So these are thresholds. This is one threshold. So the next time there is a crash, it does not go and fall below this threshold. See, this one did not go and fall below this. This did not happen, correct? So this became a threshold here. Then this became a threshold. Then this became a threshold. And now this, sorry, this is the wrong drawing. This is exactly the threshold which we are at. So we have reached a threshold. And why am I saying that we are almost going to reverse? Can you zoom into this area, please? See, there was a threshold which was reached, which is the bottom, and now we are seeing a green little star here, which means that perhaps things are going to reverse. This is always what happens. It goes down, quite dramatically, very fast, and then we have a green bar or a green star or a green something happening. Every time this happens in the past, there's nothing extraordinary this time, which is why I was saying that if we start considering this as a pure volatility event only, garner all the resources and invest very aggressively, perhaps we will be able to enjoy a beautiful rally going forward. So that is the submission from S&P. Now let's look at one by one. Let's look at all the some of the Indian sectors. Okay, can you go down to sectors? Do you have sectors here? Yes. Okay, so this is the PSU bank. Okay, previous threshold, making a threshold and turning around. Okay, go to infrastructure. Okay, infrastructure. Wait. Okay, fine. Now just stay steady. Don't move. Don't move. Let it be. This was the previous threshold. Zoom karo isko. दिखाई नहीं दे रहा. Yeah, this was the previous threshold, and things are turning about. This is infrastructure. Now let's look at technology. Go to the next one. Okay. See, the thing is, it's come very close to the previous threshold. It's made a new threshold, but there is a little bit of a, green indication. So, which is why I'm thinking that we should be done, and maybe this is the reason I'm saying correction should be sorted out. Okay. Let's look at the next one. Let's look at pharmaceuticals. Okay, so pharmaceuticals has been very, very steady and very strong. Everything that has happened, pharma has really not got affected that badly. This was the previous fall. This was because of tariff and the Operation Sindoor and all of that. This is last year's, huh? Just for your knowledge. Okay, then let's go to metal. Okay, metals has been surprisingly very strong. Metals, there's hardly a little bit of a fall. So metals has been one sector which has been kind of insulated. Acha, by the way, this metal does not include gold and silver. This is all other metals. Aluminium and the steel and iron and all these kind of companies that deal copper, etc. That these are the companies who are dealing in metals. So metals has been very, very strong and resilient as a sector. No major damage there. Okay, go down. Auto. Okay, sorry. Okay, this is automobiles, right? Okay, let me just remove my previous drawing. Automobiles again, previous threshold, new threshold, and a little bit of turnaround. So in essence, nothing is. I mean, everything is looking very bad, but everything looks like the bad is over. Okay, is there anything else left? Any other sector? Okay, this is banking. Yeah, pretty much the same thing. Okay, can you go to real estate? You didn't show real estate. CNX Realty. Okay, fine. Real estate. So if you can see real estate also, there is a little bit of a green shoot happening. Correct? So see where it's falling, we don't know. This has been an extraordinary situation. This is the first instance where we saw that the previous threshold has got broken down, right? So, but then luckily for us, we are seeing a little bit of a reverse move happening. Well, this is the first time this is what happened in the realty sector. This is the only sector which was damaged the maximum in this fall. So perhaps real estate. So these are real estate companies, and these are the companies which are this index is made by the builders whose properties we are typically buying every now and then. Okay, so that's good enough. Now let's come back to our presentation. Okay, so having said all of this, where data says that we've not fallen so many times, the worst is behind us. War and impact is okay. Fundamental data is okay. Technically, all the charts are looking okay. Sector movements are okay. So therefore, there are three extremely important things to be done. Okay, going forward, and a lot of us are not going to really like this. I mean, but well, that's the reality. Okay, so one thing that is loud and clear, and you've seen this in a lot of your portfolios if you've been with us, that we tend to have 30 to 40% allocation in sectors, right? So sometimes we invest in pharmaceuticals, sometimes technology, sometimes we move sectors, we come with those recommendations also. So a movement of sectors has become even more important. Uh, you all have obviously seen the kind of rally that happened in gold and silver. We have been talking about gold and silver formally since the beginning of 23. We are doing a session on gold and bullion market. We're going to do this in next month in May. The last year we did again was in May, where we did gold part 2, and the part 1 we did was in 23. So we were talking about this huge trend that we saw happening in gold and silver, and the trend is still very good. The sector is still great. It's a great recommendation. It's a great area to invest. But then at the beginning of this year, we also saw that we had to get out of this area because because the volatility and the swings are also so severe that sometimes it can just erode all the profits which we have made over months. It can erode those profits in days together. So fortunately, unfortunately, I hate to say this, but the way the situation looks, the way the political situation, the way the not so much political, the geopolitical situation, this is all not going to settle down very easily. So the Russia-Ukraine war, which started in 22, is still in some form going on. I mean, there are escalations that happen, and then it kind of settles down for some time, where they talk about peace and being okay. But what they are really doing is they are building weaponry, and they're building their arsenal again to go and. I mean, it's not got solved. They're building arsenal to fight again. These kind of problems are happening not only there, but they are happening all across the world in different ways and different levels of intensity. What we may see going forward is a lot of volatility. And I'm not talking in terms of 3 months or 4 months. I'm actually talking in terms of the next 4 or 5 years. Uh, it seems that the kind of a trend that we really enjoyed over the last maybe 10 years or so, over the last 10 to 15 years, that trend may remain the same, but it will give us a lot of volatility. There will be a lot of sideways movements in the market. Okay, what we have to again be cognizant of the fact that because of last year's tariffs and this entire upheaval in the trade and the business of all the companies in the world, it's going to take some time for even the companies to settle down. So the damages, the losses of last year, or the businesses that could have happened, or the growth that could have happened, which has not happened, might take some more time to stabilize. And which is why we may not see huge 30-40% jumps in terms of sales growth and profit growth. It might get a little more softened. And because of that, you will see that there will be some sectors which will do better. Like right now, metals, as you saw, is doing pretty much better than everybody else. So something will do better, something will not do so well, something will just remain sideways, like you saw in pharmaceuticals. So what will have to happen is, while the core strategy of our large cap, mid cap remains intact, we may have to move around sectors a little more. We may have to become a little more active. Uh, so what happens is, the moment we are active, the implication of being active is that we will have to book some profits. So, for example, if we were in a metal sector, or if we were in gold and silver for last year and we have exited that, we have obviously had to pay some taxes, or we will pay taxes as we move along. So, the unfortunate bit is, a lot of us don't want to sell because there is profit already that we have accumulated. A lot of us feel that mutual funds have done beautifully well, but mutual funds have also struggled quite a bit alongside all other kind of portfolios, whether it is a PMS, or whether it's an AIF, or whether it's your equity portfolio or a mutual fund. Typically, 25 was a year of basically -5 to +5 kind of a situation. If you came at the worst time, you were probably at -25. If you came at the best time, seemingly best time, then you would be at a +10, but or maybe a +12 or 15, but you're not really exceptionally good or exceptionally bad. But the point is that if there were profits of 22, 23, 24, all of that, and we needed some money, we would have to book profits. That becomes a very, very important submission. So that little video that I did yesterday, there are three very important things to do. So one is obviously sector movement, sector rotation. We will need to do that a lot more. Earlier, we would do that maybe once in about 2 years or 3 years, but maybe we feel we might have to do that on a yearly basis, or maybe on an 18-month basis. Let us hope that we have a favorable situation, and that we only get into a long-term tax, which is at 12.5%, and we don't have to bear the short term. But sometimes, if we have to bear the short term, we'll have to do that also. And sometimes we may have to bear a tax which is a little more than that. So one is sector rotation. Second is profit booking. Obvious implication of that being that we will have to be pretty reasonable and open with the idea that tax is a part of our life, and let's pay. Because if we don't pay taxes, what happens? The profits just get eroded. And if we postpone taxes, which we can do technically in mutual fund forever, but then in future we might pay a higher tax. Like today, the tax is still 12.5%. Maybe 2 years down the line, it could be 15%, and maybe 10 years down the line, it could be, who knows, 20%. Or, I mean, that's at least the direction that in which the finance ministry is moving. And the third very important thing that happens, and these are all interrelated, right, is that we need to have cash all the time. We are trying our best. Can you bring that strategy up? Can you bring the presentation? So what we are trying to do from time to time is have a little bit of cash available. This is obviously easier to do in an equity portfolio, not so easy to do in a mutual fund portfolio. But anyway, we will have to do that. So what happens is, how will cash get generated? Again, cash will only get generated when there is a profit booking that has happened. And profit booking will only happen when we decide to do a movement in some sector. So the point is, going forward, can you go forward, please? So going forward, I think the strategy should be looking something like, in this kind of a fashion here. And what this basically means is that we always want to have, for example, about a 20% of our money in gold and silver. That is something that we are going to recommend to do all the time for the next few years. At the same time, the as a cushion or as a shock absorber, we want to be in large caps, which is about 10 to 20%. It's like little bit of a range. And mid and small cap, we want to be about 20 to 30%. So effectively, about 40 to 60% of the portfolio is, the core portfolio, which is large, mid, and small. We will not want to do too much of movement with this, because the fund manager on his own is also going to do some activity. But what we will do is, here is where this becomes very important. Let me just remove all my drawings here. This is the area which is very, very important, this little triangle here. So about 30% of the money, if we are going to be in a situation where we have choices of sectors, themes, gold and silver, and international. Uh, so international at the moment is not really very nicely available, but we are trying. The moment this thing opens up, or if there is a method of getting into international, we'll do that also. But having said that, this, if 60%, but if I make a big line here, if about 60 to 70% of our portfolio is going to remain steady long term, we keep growing, we need to have about 20 to 40% of the portfolio here, which needs to be between cash, and most of the times we'll be invested in gold and silver, but cash or some theme or some sector, maybe pharma, maybe infra, maybe housing, maybe something else. But we may have to be a little more active. And what that means is, to generate that cash, we'll have to sell something. When we sell something, we are obviously selling on the basis of sector movement. So that's something that I wanted to make a submission, that going forward, we may have to become a little more active even with the mutual fund portfolio. And with that, I want to close this session for